with my looking at both, where everybody, Buffett included, wants both value and growth. I want growth, and I'm prepared to live with some slippage on value. The 9, 10, 11% grower just doesn't interest me, because with all the stuff that's happening in tech, there is enough out there that's growing at 15% a year.
So it was great here going through your letters now. It's been a couple times. I prepped for our first interview back on millennial investing and now for this one. And one of the themes that I've noticed in a lot of your newer letters is both growth and value. Now, I think that, many investors who buy these growth type businesses consider themselves value investors, even though they might own businesses that trade at multiples that would make the most, traditional value investors just run for the hills. But you guys have a very clear set of metrics that you track very clearly that state according to your own numbers that include things like revenue growth and earnings growth, that many of the businesses that you own are cheap relative to their growth. So can you just review how you use these metrics to help determine if something is cheap, reasonably priced, or overvalued?
Yeah, so I'll jump in, and I think a starting point would be to look at our process. So what Jason and I each have is what we call our stock trackers. So we have our universe of stocks that we're looking at, and it's changing all the time. But what we're doing is we're trying to compare apples to apples. So if you say this company looks cheap, this company looks expensive, we'll take that numbers and we'll compare it to our universe, being like, okay, well, on those growth metrics, on those earnings margins, on that PE, actually it doesn't look that good because I can find 20 other stocks that look a lot better, right? So maybe it is really, really cheap, and if it's only growing 10%, maybe it does screen really well. But I think that's where we start is it growing? What's its, return on equity? And then what's its multiple? And if you just take any stock without comparing it to anyone else, yeah, maybe it looks good. But what we're trying to do is we're trying to optimize, right? So we're only trying to own 10 or 15. Maybe we'll make money in a name, but we're trying to find the best 10 to 15. Jason, I don't know if you want to kind of jump in on that.
Yeah, well, I would say that our thinking on valuation has evolved quite a bit over the years, or at least in my case, because I've been doing this since the early 90s, so 92, 93, right? And originally tend to look at growth a little bit more simply. And there was a ratio we used to have called the Lynch ratio, which is you wanted the company to be growing faster than its PE. So if it was trading on 15 times, you wanted better than 15% growth. Then we evolved into return on equity. So we were looking for companies with consistently high returns on equity, typically 20% or better. Then what had happened with so much M&A is the balance sheets got distorted, that calculating ROE accurately became a problem. So then we started in the last 5 or 6 years pivoting to the rule of 40, right? Which is the combination of the revenue growth plus the margin of the company, right? All three of those approaches, so the Lynch approach, the ROE approach, and the rule of 40, they're all kind of trying to get at the same thing, which is some kind of a quick and dirty metric when you're screening a universe of 10 or 1,000 stocks to allow you to get down to 30 that you can take a closer look at. So I would say now that we look at the rule of 40, but when you're doing a factor dive into a database, right? And for people who are listening to this podcast, they'll know what I'm saying here. And you're really looking for 4 factors. You start by, let's say, factor 1 would be market cap. I want it to be $1 billion market cap and greater. So you sort your database, that cuts your database in half. Then you say, I want companies that are only growing at 15% or better. Boom, you put those factors in. The point is that those 3 or 4 factors you pick and the order in which you look at those factors has a big influence on what you're ultimately going to look at. And with my looking at both, where everybody, Buffett included, wants both value and growth. I want growth, and I'm prepared to live with some slippage on value. There's other people who are hardcore value investors where they're value first, and then they'll rationalize growth kind of later, right? So you kind of have to get a sense of what's your natural tendency. And in the current environment, particularly with so much interesting tech stuff going on in the world, I'm not really interested in initiating a new position. And I think Jesse would probably be similar, but I'm not, if they're not growing by consistently at 15% per year. The 9, 10, 11% grower just doesn't interest me, because with all the stuff that's happening in tech, there is enough out there that's growing at 15% a year. And the margins of profitability, we can make that a separate conversation. But as far as that starting point that I'm looking for 15% growth. Go ahead, Jesse.
What we talk about a lot is, what we look for is, we call them compounders. There's probably more that gets thrown into that than it should. But the idea of compound growth, from what we can tell, and we've done historical studies on this, is it's just continually undervalued by the market, right? Like humans can't really, like we think in a linear manner. So if you're saying, if this company is going to compound at 15, 20% for 5 years, you could put a significantly higher multiple on that and still make money, right? Like if you do that with 5, 10 years of compounding. So that's why I think that whole value growth, it kind of gets a bit disruptive. There is a lot of value in growth, but when you have a company and if it's growing and so it's improving its underlying value of its business at 20% a year, the stock could fluctuate around, but 5 years from now, if it's growing at 20% a year, I guarantee, you've made a lot of money unless you got extremely overpaid. And I think there is a bit of valuation discipline there.
Yeah, thank you. I resonate a lot with that. So just from going through your letters and talking to you guys, I know that you guys are long-term business owners, which I really appreciate. And, you're looking for businesses that you can tend to hold for, let's say, 5 to 10 years. And kind of like you just mentioned there, Jason, the business world is changing pretty rapidly. And a company's competitive advantage can kind of erode pretty quickly here if you take your foot off the gas pedal. So, I don't necessarily think this is a new convention, but I've noticed it on a couple of the businesses that I've owned that I thought had very secure moats and then ended up being pretty weak. So my question here for you guys is, how often do you guys think you're missing the mark on some of your picks? And given your concentrated nature, how are you mitigating some of that downside risk?
Yeah, I would start with, like you said, a deteriorating moat shows up in the numbers, right? We've owned Constellation for, what is it, like 15 years or something. And, the idea was always, law of large numbers or competition, and now the AI side of it. Well, if that moat starts to deteriorate, you'll see it. You'll see it in growth. You'll see it in margins, or the other argument was that they'll have to lower the hurdle rate. Well, that'll show up in the numbers. You're looking at every single quarter and you're on top of every single metric of that company. Like there's yellow flags, red flags along the way.
Yeah. And you can get these things where a company is growing at a really good clip and then it goes through a growth slowdown and then it reaccelerates, right? And we've had a case where we've come out of some important names and then gone back into them, right? So, for example, we own Constellation. We started buying Constellation at, believe it or not, $20. The stock's at, it's almost at $5,000, right? So it's beyond 10 baggers. It's beyond 100 baggers. It's one, but we lightened up in the middle because they went through a growth slowdown where they couldn't figure out how to grow much faster than 10 or 11%. This was back in like 2014, 15, 16. So we lightened up. Then they figured it out and they reaccelerated, and now they're consistently growing at 20% a year. So we've taken it back to a large position, right? So it does happen. There's a couple other companies, like Enghouse is a company that we've had for 5 years, and then we get rid of it because they go through these kind of sprint and then they drift and then they sprint and then they drift. So it's not a perfect science. There are some companies you can just kind of, you buy them and they go forever kind of stuff, but you got to continuously stay on top of them. And even in the largest cap world, like Apple's been a great company for years, but it's not growing anymore. At some point, either they're going to have to have huge innovation because of the scale of the company to get it growing again, or it could potentially become the next IBM where it just chugs along sideways. It's a cash cow, but there's not a lot of growth there. So they don't all go on forever. And sometimes they run out of growth for a variety of reasons. And you just have to be kind of staying on top of it and then saying, okay, if Apple's slowing down and it's going to go sideways for a while, what are my alternatives? And there's always an alternative. So.
Right. So let's talk about an interesting term that you used in one of your letters, which was yarak. So yarak refers to a super alert state where the bird is hungry but not weak and it's ready to hunt. So you wrote about this specifically in the context of staying alert, no matter, what the market is doing or how successful you've been in the short term. And I think this is just an excellent concept because it's really easy to get complacent and rest on your laurels, in times of peak euphoria. So you guys have had a lot of success throughout the years, not just recently. And so I'm just interested in learning, how are you guys maintaining this concept of yarak in your investing practice?
One is the complacency during good times, but it's also during bad times too, right? You almost want to go bury your head in the sand. And, Jason says it all the time. It's like, no, we keep showing up every day because you never know when, we have a couple phenomenal investments last year. And, it's just from showing up, turning over rocks, doing our process. Then all of a sudden, you never know when that's going to happen. Jason and I were actually talking about this yesterday. We had a couple of great ones and you're like, okay, when are we going to stumble across something? And we might have started yesterday. We might be on top of something. Like you never know when it's going to happen. And, I think one is just, we love what we're doing. So, we're showing up, and that's what gets us excited, is trying to, find what is the next best up and coming investment and trying to get there. So I think it's just, you have to have that mentality maybe within you, but I don't know, Jason, if you something else about complacency or not.
Yeah, I think I've noticed like through the bear markets, right? And the COVID driven bear market of 22 was probably the toughest one I've had in my career, right? Because it lasted longer and it was deeper, right? But I remember saying to Jesse as kind of a pep talk, don't turn away from the screen. Stay completely engaged through this, because when it turns, if you're on top of what's good at that turning point, you will make a fortune off of those companies. And some of those stocks last year were within a 12-month period, 5, 6, 7 baggers within a 12-month period, because they had become so beaten up in terms of multiple, right? You don't get those in the middle of a cycle or at the end of a cycle. Those are usually that first year coming out of the trough. You get some spectacular rebounds because people just walk away from stuff and they tune out. They don't realize where the value is. So, and it's a way to keep your concentration going through a bear market, because bear markets are hard on the souls. If you don't, the people out there don't think we take it personally when the fund is down 3% in a day or something like that. Trust me, we go home and that's all we think about for the next 24 hours is the fund was down 3%. My clients all think I'm an idiot. They're going to pull their money. What's the future kind of stuff, right? So the way to get over it is stay focused on what's happening. Update continuously. I know it's painful, but stay engaged every day. So that would be my advice.
So let's talk a little bit about the performance of the Donville Kent Asset Management. So you're currently outperforming the S&P 500, which you've actually managed to do for much of the fund's existence as well. But you definitely did have some trouble back in 2021 through 2023. So I'd love to kind of dive into that a little bit. Was there any point at this time where you felt like maybe your strategy wasn't valid anymore and that you'd have to make some sort of strategic shift? Or were you well aware that, patience was all that was needed for the market to kind of see what you guys were seeing specifically in the businesses that you guys owned?
The big jump in interest rates caught us off guard. That's what we didn't see coming, right? We didn't see that the supply constraints coming out of COVID was what's going to whack us, because we actually were doing okay up till then. So for us, it's specifically 22 as a year, we just absolutely got our butts kicked, right? And most of it was multiple compression. So growth stocks that were trading, this is using mainly Canadian stocks, that were trading on 14 times earnings and we're growing. By the end of the year, we're trading on 5 times. And then guess what? Last year, we were up over 100%. So a lot of those stocks that were trading on 5 times just went back to trading on 12 or 13 times again. Our average company was not growing 115 or 20% last year. The huge amount of it was just multiple expansion as interest rates started to come down. So we didn't see that. We didn't see that coming. And it's part of the business that we get it right a lot of the time. We get it right more often than not. But in the 17 or 18 years I've been doing this, we've gotten our butts kicked twice in 18 years. 22 was one of them. And then that 08, 09 also was pretty tough. But the thing is that the back half of 09 was so strong that on the annual numbers, it doesn't seem like it. But if you took the worst 6 months of the 08, 09 period, same thing, we're down really, really hard, right? And then you get that resurgence and it kind of makes the year-end numbers look fine. And therefore people are like, oh, they did all right. It's like, okay, but if you looked at us at the end of April, if you looked at April 09 at the bottom of the worst month, right? It's like, oh my God, these guys are idiots. And you would have concluded the same thing in 22. Of course, when you've been riding high for a long time, there's a lot of people that quite enjoy watching a guy who's had a pretty good long run, or a couple of guys have a good long run, get their heads handed to them. And it's part of the business.
Yeah. And to your point, Kyle, like strategy and did we make poor investments? If we were looking through our names, so this includes 21, 22, 23, 24, I'm going to round the numbers, but it was 95% of all of our top investments had record revenue and record earnings. Following year, record revenue and record earnings. Following year, record revenue and record earnings. So the companies were doing what we said, they're compounding, they're doing well over that time frame. And the stocks are declining, like mostly from that multiple compression as interest rates went up the fastest pace in history, right? So you sit back and you say, well, and you get that question, well, what would you have done differently? And you're like, companies performed extremely well. Most of them better than we had modeled or even expected, right? So, and then now we own mostly a lot of the same, we kept those investments going. And again, they massive rebound last year and they look like they're going to have phenomenal 2025. So, what did we change strategy? No. Was there some, bad investments that went bankrupt? No. It's that timing the market side that, we don't think many people or if anyone can do. But
I'll give you an example. There's a company called Vertical Scope, which we own. and it's just been ripping. We still own it. It's been ripping, year to date. I think it's up 17% year to date, and we still think it's one of the cheapest things that we own. So this thing, like pre-22, was trading for $30. It went to $3, right? So a year and a half ago, when Universal first time, it was around $3.50. It's at $12 right now. So it's gone from 30 to 3 back up to 12. It's been growing that whole time. I said, I was on TV a week and a half ago, and I said, this is a $25, $30 stock. That only presumes it gets back to where it was in 21 or 22, but it's been growing that whole time, right? It's the Reddit of Canada, for lack of a better word, and it trades on 7 times earnings, right? I said, this thing should be 14 or 15 times, right? And I mean, Reddit could acquire these guys at a 50% premium, and it would be massively accretive to Reddit kind of thing, right? It's not as big as Reddit, and it's kind of a different kind of, a little bit different, but it's 1/8 the size of Reddit. As an acquisition, it would increase Reddit's earnings and its revenues by 15%. It's not that small that wouldn't be something attractive, right? Well, this thing went to 3 from 30. Now it's back to 12 and a half. And I think within 3 or 4 months, it'll be at 25 or 30. That's the world we live in.
So with your guys' strategy, obviously you probably didn't take into account those interest rates, and you knew that maybe some of your names would get beaten up. So I'm just interested in learning a little more about your perspective of that, being, an institution here who's managing other people's money. How did your partners feel about that? Do you guys have just these really good relationships with them so that they understand what you guys are doing and they're okay with, taking some of the bumps along the way? Or please just expand on that as much.
Well, first of all, we weren't ignoring interest rates. We were just wrong. We just didn't think they would go where they were. Because remember, coming into a COVID, we're living in a deflationary world, right? It wasn't that long ago. We're talking about negative interest rates, European institutions offering you negative interest rate to hold their currency effectively. You mean I'm going to put my money in a European currency and then I'm going to pay them another 0.5% just to hold that currency? Like, that's how crazy it was. So we just figured that we'd be back into a deflationary world pretty quickly, right? Our read on it wasn't that we ignore interest rates. We just got it wrong. I'll let Jesse kind of finish the answer. But when you screw up, full disclosure, when you got it wrong, just like call a spade, because then people will just think, oh my God, the guy smooths over all his mistakes. We just didn't think that interest rates were going to go as high as they did. We got that wrong.
Yeah, and Kyle, I know you follow what we write, we put out, and that's what we write and put out and speak to our investors. So to your point, obviously, we're large shareholders in our fund, so we felt the pain. So obviously, other investors felt the pain. What we did is, we try and just keep our investors on top of what we're doing. Like, we're very open and honest. We write, very detailed quarterly reports, monthly commentary saying, this is what we own, this is what you own, this is why, this is what's happening. And I think, at least, educating to a certain degree, I think helps people understand that, we're not a black box, and these companies aren't going to zero. So it's that type of, and, a lot of the investors have been with us a long time. They understand, volatility to a certain degree, and they understand what we own. So I think that the educating investors and, just being open and honest, I think helps, especially in the long term.
So speaking here towards what happened while you guys dropped here, I think it speaks a lot to the next subject here, which is I want to talk about, which is resilience, which, I think is just an incredible characteristic, almost a necessity to have in investing, especially over a long time period. I think that, any manager who's been involved in investing for a long time period and is still around and is still successful like you guys have to have some form of resilience in some way, just because, you're going to have to be dealing with being a punching bag for the market, at least some of the time that you guys mentioned, twice kind of as is what you guys have had to deal with. So how have you guys kind of managed to continue performing at these high levels during some of these lengthy drawdowns that you guys have had to go through?
Well, let me speak to that, because I've done a little longer. We've only had we've only got really whacked twice, right? And like I say, in one of them, it was short enough that we got back into the good so fast that a lot of clients almost didn't notice it, kind of thing, right? Or some did. So really, the really only tough one is 22. I think now I'll kind of shift to resilience in general. Yeah, it comes from a lot of different places. It comes from how you were raised, the lessons your parents passed on to you, the life experiences that you have through things other than your work. Jesse's a professional athlete. I've been involved around athletics a lot of my life. I'm ex-military, so you learn a little bit of how to be cold and wet and miserable and still manage to, get through your day kind of stuff. So there's different life experiences that build you up to that. But I think at the end of the day, you believe in each other and you're decent people, and you just go, yeah, it's like that scene in the first Gladiator movie where he just gets everybody in the middle of the ring and just sort of says, everybody form that circle, right? And we're going to just fight this thing together. And that's what we did. And the team bought into that, and we got through. Kyle, I don't know if your investors know that Jesse, he's a hedge fund manager Monday through Friday, but he's a professional athlete on the weekends, right? And he's, he's also like a CrossFit freak kind of stuff. So he's super fit and all that kind of stuff, right? So he's still playing professional lacrosse and doing this day job kind of stuff. And that's pretty impressive because Jesse's not a 25-year-old professional athlete, right? He's part of the reason he's still playing is he's super fit. And I think it speaks a lot to his kind of mental strength and things like that he can manage both the portfolio and also be a professional athlete and be that fit at the age that he's at to be able to do that. So I think that alone tells you a lot about the guy's character and his kind of having his priorities together. So.
Yeah, no, I knew, Jesse, that you were a professional lacrosse player, but I didn't know that you were still a professional lacrosse player. Can you maybe talk about some of your own experiences that have helped build your own resilience?
Well, I would just sports in general, you don't always win. And how do you react to losses? And to be successful, you obviously have to react in the right way. I think anyone that's played sports kind of understands that. But to Jason's point, I think he himself and us did, we circled the wagons well. And it's that mentality, you could quit, sure. Or you could kind of do what's right for your firm, your employees and your investors, and you battle through. So it was a hard year, but again, I think we're 1 year into kind of this next cycle. So I think we're actually pretty excited, especially what we're seeing out there.
So speaking of cycles here, let's get into a little bit on maybe some of the macro. I know you guys aren't macro investors, which I very much resonate with, but there's definitely some overarching themes that I notice that you guys like to talk about, especially in 2024. So, at the beginning of 2024, you guys had this thesis that the businesses that you owned were going to continue increasing profit margins, continuing increasing earnings growth, and then hopefully also see some multiple expansion. So can you maybe just provide an update on how this played out in 2024?
Yeah, so you definitely saw multiple expansion, right? We had many companies trading on single-digit PE multiples. Today, we probably have a handful that are still trading on single-digit PE. So you definitely saw multiple expansion. You saw earnings growth. You saw margin expansion. For a lot of our names, we think growth even accelerates this year. Margins accelerate again. You won't get the same type of margin expansion because, one is, it's that inverse of the interest rates too, right? So interest rates got cut, but we don't think they got, at the same pace as maybe those previous cuts the last few months. So it did play out kind of, as expected in the sense of those three factors. But again, we're not macro, so it's just going through name by name. And if you're looking at name by name right now, like we're excited, they excite you for 2025, 2026 when, revenue growth there, margin expansions there. And then, you don't rely on multiple expansion as much.
I think, Kyle, though, there was a macro setup at the start of 24 that's worth just briefly re-looking at. And there was really three factors at the start of 24 that were really positive. The valuations were low in the small to mid caps. The weight of money, people were underweight the small to mid caps, and interest rates had peaked and were coming down. Those three things. You go to 25 and you sort of say, okay, so let's revisit those three things, right? Interest rates now look like they're going to go sideways, right? I don't see Canada, they might come down a little bit, but in the States, economy's rocking. It's hard to imagine interest rates are going to go much lower. So people are discussing how many more, one more, two more cuts. I don't see it unless somehow Trump puts pressure on, on the Federal Reserve, just whatever, even though it's supposed to be a non-political organization, let's call it a spade. And so interest rates are going to be neutral as opposed to a positive. Valuations, though, are still pretty reasonable, in part because the Mag 7 and the mega caps are pretty expensive. Right. And so the weight of money is improved a little bit, but people are still relatively underweight because it's been too easy to just hide out in the Mag 7 or in the ETFs that are dominated by the Mag 7. Right. So at some point, you're going to get a valuation differential. And I think it'll be good for people like us who are stock pickers in the small to mid cap area. That said, I wouldn't buy the Russell 2000. That's on the way of diverting people away from me. That basket's full of a lot of garbage. So it's not really an asset class. If you took the Mag 7 and just bundled together and said it's a single company, it's a rocket ship. It's just expensive. That's all. But the earnings and the profits and all the margins are phenomenal. You take the 2,000 companies in the Russell, it's garbage, right? There are good companies. It's got to be somebody who can look into that Russell and identify the 10 or 15 that is the way to play small caps and mid caps in America, and the same thing in Canada.
Yeah, we actually wrote about that kind of in detail, because we were saying, look, like this is the largest divergence between large cap and small cap. So if you believe in, reversion to the mean, small cap looks phenomenal, still does extremely phenomenal today. But we broke down the Russell 2000, and if you want, you want revenue growth, you want earnings growth, you want a profitable business with a decent balance sheet, of that name, we wrote about it, we broke it down, but it was like 2 or 3% of that whole index kind of fits metrics that you would ideally want in a business. So that's not, if small caps look good and look cheap, there's probably better ways to get there.
So let's go over the rule of 40 that you guys kind of already mentioned here, which I really like how you guys use it, because, when I first came upon it, it was, kind of only used on tech businesses, kind of those SaaS-y type businesses. But you guys have kind of broadened it out and used it kind of everywhere, no matter what kind of company is in, what business it's in, or what industry it's in. So, just for listeners of this who don't know what the rule of 40 is, it's essentially kind of a tool used on generally, like I said, software businesses to help determine if a business's growth is healthy. So to calculate it in the traditional way, you add revenue growth and cash margins. And if those two numbers equal or exceed 40%, then you're looking at, say, let's say a pretty decent business. So just an example of that, let's say a company's growing its revenue at 25%, has 50% cash margins, then you beat the parameters of the rule of 40. So I'd actually, since you guys now have made it kind of a bigger part of your own investing, I'd love to know how you guys look at both the two parameters inside of this, and which of them you guys think is maybe the most effective and predictable for future value creation.
Well, and there's a couple of things to think about. So the rule of 40 is if you're looking at a compounder that you can hold for a while, and it's at that 40, and the valuation isn't ridiculous. And I would say ridiculous in nowadays market is probably over 35 times earnings, right? That's 25 times is not ridiculous anymore for a consistent compounding, because a certain number of people have figured out. So 40 or better, you kind of know where, this is now a long-term buy and hold. So that's what we look for. However, we also want to look at the companies that are not at 40, but they're rapidly going to 40. So you actually get more upside from finding a company that's say at 20, but you can see, oh my God, last year it was a 17, this year it's a 20, next year it'll be a 25. That's actually the most powerful. So it's on its way to becoming one of those, right? And typically where you get that is where a company has got consistently high sales growth. So they're growing at 15 to 20% sales, right? And then they're crossing break even. But you can look at the nature of their business and say, okay, this company should have margins that will go to a certain point, right? And I'll give you an example in our portfolio in contrast with a large American company. So there's a large American company called Doximity, which does software for doctors, right? There's a small version of that company in Canada called VitalHub, which does healthcare software. So VitalHub, when we've owned it, their margins were about 8%, but they were growing at the level of Doximity, maybe even faster. But their margins were at 8%, and Doximity was at 40%. So we said, if over the next 5 to 7 years they can move that from 8 to 40, the re-rating of the stock will be phenomenal. So now, Jesse, what would you say VitalHub's at now? About 25. So they've gone from 8 to 25, but there's still another 15 points to get.
They still think they can get to 40.
And they think they can get to 40 as well. So that's really where you get it. And so when you're looking for that playoff between the margin and the rule of 40, start by looking for the revenue growth. And if you find a company that's just crossing break even, don't freak out that they're on 65 times earnings, because that margin, if it goes from 2% to 4%, that 65% times earnings can become 15 times earnings like that. The better way to measure is if it's priced in, is what's the price to sales ratio. Because you can look and say, okay, a mature rule of 40 company that is kind of trading on a stable valuation, what is a normal price to sales? And it's often 20, 25 times the price to sales multiple for a company like a Doximity. And if you say, oh, this guy's crossing the break even, it's on 65 times earnings, but it's only on 3 times sales, but the margins are coming up quick, ignore that PE or cash earnings ratio because it's just temporary because the following year, right? And you're seeing a lot of companies like, Shopify is going through that rating right now. So I think of larger names, people like Shopify, even Amazon is starting to become like margins are coming up, right? So, and then we take that same logic and apply it to small and mid cap companies in our area where you go, wow, look what's happening to look what's happening to the margins that's coming over the next 3 years. Stocks on 45 times this year's earnings, which seems expensive, but they're growing at 22% a year and the margins are coming really fast. This thing might be only on 7 or 8 times 3 years forward earnings, right? So that's kind of, now, just what I described all sounds easy. You only get a couple of those, like you get 2 or 3 of those a year. Like it's not that, like they're like a million of those lying around, but that's certainly what we're looking for.
So I think that's a really good segue here into my next question that I want to ask. So, in one of your net letters, you had this really, really good graph that kind of showed the optimal zone that you guys like to purchase in according to its maturity levels. So you listed 3 levels that I like to go over here really quickly. So stage A was kind of a concept stock, which I guess you guys would probably consider a business that maybe only has, rule of 20. It's not quite there yet. So these are, pre-revenue, maybe unprofitable businesses, higher failure rates, higher risk, and need for financing. Then you move into the zone that you guys like to look at, which is, businesses that are high growth, but also profitable, businesses that tend to be overlooked, businesses that have minimal or preferably no analyst coverage. They hopefully are undervalued and now they're at a point of maturity where they can self-finance themselves. And then stage B that you guys wrote here was mature stocks, which are, slower growth, but profitable, tons of analyst coverage, stocks that are fully priced and very well-known brands. And I think you mentioned a couple of them, Amazon, of course, is one that everyone's going to be familiar with. So you mentioned here that you use that rule of 40 kind of as a benchmark as to kind of prepare yourself for businesses that maybe are getting to that zone. Will you buy ones where you have high conviction that it will go, from 20 to 40, or are you generally going to wait for it and, get a little more conviction and want to see the business perform and execute at a high level before you eventually make a starter position?
I think the best way to answer it is with an example. So Jason already was just speaking to Vital Hub. We met with them in our office when they were literally just weeks public, and they said, this is what we're doing. This is the idea. They were just one little piece of software, not profitable, but they had recently just sold a similar business. Now they were coming off for non-compete. Yeah, we're doing it again. This is the plan. Yeah, you're too early for us, right? You're unprofitable. It's not that proven, but no, we like you guys. We like what you're doing. It was a few quarters later, they put in a couple other extra pieces of software. They break, profitability, and they say, yeah, this is that now they're doing what they said they were going to do. And so I think we first initially invested with them at around, $1.70, and that stock's at $12 today over the last 5 or 6 years. And so that's one where we're meeting with companies all the time in that concept A, like you say, that we try and stay away from, because like Jason said, you'll get 1 or 2 of those that actually come through. You might have to take 50 meetings, 100 meetings, but at least you're on top of them. So when you first see those companies breaking the margins you're looking for in the growth of your market, you're not starting from scratch. Like, you're on top of it. You either like the guys, you don't like the guys. You already have an opinion, and then you can react a lot faster.
Yeah, I think that slide that you're talking about, Kyle, it's a nice graphic that shows you like the stage in the company's development, right? But I also think you can quantify that a little bit. I was reading a report this morning that was looking at 10 baggers in the U.S. market, and a couple of academics have done this study on 10 baggers essentially over a decade. If you want to get a stock that's going to go up 1,000% in 1 decade, right? What are you looking for? And the guy said, he did a couple of academics did a big study, and the average company that became a 10 bagger, the market cap at the start of that decade or that 10-year period was $3.3 billion, right? So for most Americans, that would not even quite be a mid cap. It would be a small to mid cap, right? In Canada, we because we're 1/10 the size of the States, we typically take everything in the States and divide it by 10. So in Canada, that would be about a $350 million market cap. And that's completely consistent with what Jesse and I see as the sweet spot for finding these great companies in Canada is 350 million to about 2.5 billion when they're just coming on the radar screen, but they're fairly illiquid. You can get time to get to know the management. So the stage in the company's history is important, but also the market cap, right? Because, it's just the likelihood that Microsoft or Apple, when they get that validated, I think I think Microsoft's a good buy and hold stock for somebody so I would recommend that as a good, safe company that's probably going to grow at 12 to 13%. But if you're looking for that big score, you got to be down in this. If you're a U.S. investor in that short $3 to $4 billion market cap, of which there's tons of great companies. And in Canada, same thing, under three, between 250 million and the 3 billion. And when you look at all of our big winners, most of them are actually even below 350 when we started out, right? Vital Hub way below 350, Zedcore way below 350, Enterprise way below 350. In fact, some of them are just starting to punch above 350 right now, but they're not so small you can't buy them. Like, these are, for somebody who's listening in the States, these aren't like stocks that are so illiquid and so tiny they don't care, because in other markets, a $3 billion company in the States is the equivalent in Canada is a $500 million company as far as activity and that kind of stuff. So if you're searching in the mega caps, you'll find some great companies, but even in this study where they look at all the great companies, the Netflix and all that stuff, they still, the typical 10 bagger is starting at your starting point is going to be in a market cap of around $3.3 billion.
Hey everybody, it's Clay Fink here, host of We Study Billionaires. Here in a few months, Warren Buffett will be hosting the Woodstock for Capitalists in Omaha with the Berkshire Hathaway Annual Shareholders Meeting. The meeting welcomes over 40,000 investors that head to Omaha to tune into the marathon Q&A session with billionaire Warren Buffett and Berkshire managers. Since we don't know how much longer Buffett will be around to attract tens of thousands of people, I would highly encourage you to make the trip to Omaha during the first weekend of May. While I personally love sitting in on the meeting, what makes the trip extra special for me is the relationships that are built around the meeting, which is why I'd like to briefly tell you about the events that TIP will be hosting. My colleague Sean O'Malley will be hosting 2 free socials for the TIP audience on Friday and Saturday evening, and more details on that can be found in the link in the description below. And I'll be hosting a couple of dinners and socials for our TIP Mastermind community, which is our paid community for private investors, portfolio managers, and high net worth individuals. Attending the Berkshire meeting on your own can be quite a lonely experience, and I wanted to personally invite you to join the events that Sean and I will be hosting. Again, details on the free events can be found in the description below, and to apply to join our TIP Mastermind community, simply go to theinvestorspodcast.com/mastermind. That's theinvestorspodcast.com/mastermind. We'll also be sure to get that linked in the description as well. Additionally, flights and hotels can get booked quickly, so I'd encourage you to book yours as soon as possible if you plan on attending. And please feel free to email me or shoot me a message on LinkedIn if you have any questions. I would be more than happy to help. Hope to see you there. For decades, real estate has been a cornerstone of the world's largest portfolios, but it's also historically been complex, time-consuming, and expensive. But imagine if real estate investing was suddenly easy. All the benefits of owning real, tangible assets without all the complexity and expenses. That's the power of the Fundrise flagship real estate fund. Now you can invest in a $1.1 billion portfolio of real estate starting with as little as $10. 4,700 single-family rental homes spread across the booming Sunbelt, 3.3 million square feet of highly sought-after industrial facilities thanks to the e-commerce wave. The flagship fund is one of the largest of its kind, well-diversified, and managed by a team of professionals. And now it's available to you. Visit fundrise.com/WSB to explore the fund's full portfolio, check out historical returns, and start investing in just minutes. That's fundrise.com/WSB. Carefully consider the investment objectives, risks, charges, and expenses of the Fundrise flagship fund before investing. This and other information can be found in the fund's prospectus at fundrise.com/flagship. This is a paid advertisement. Hey guys, do you ever feel like you're juggling 1,000 things all at once and that your life is constantly unorganized? As a host of this show, I oftentimes felt that way, and that was until I picked up the remarkable Paper Pro. Nowadays, Thinking smarter and thinking better can give you a leg up like we've never seen before, and Remarkable's vision is to help you do just that. The Remarkable Paper Pro is a beautiful, minimalist paper tablet that looks and feels just like paper, but it's packed with many amazing digital features, helping me sort out my work life by putting a lot of it on this one-of-a-kind tool. For example, when I'm analyzing a stock for my portfolio, I can jot down notes on the company as I read their reports, or mark up the company's report itself with what sticks out to me. Then I can share my notes with others and organize them however I'd like on the tablet. In a world with constant distractions and cluttered workspaces, the Remarkable Paper Pro is an absolute must to work smarter and more effectively. It also has a high quality and premium design and feel, making it a lot of fun to use day to day. So give it a try today and thank me later. You can get your paper tablet at remarkable.com. That's remarkable.com.
Well, that's a good study, and that's kind of similar to some of the things that I've come across as well. So let's move on and talk a little bit about portfolio management, especially through the lens of position sizing. So, like I've already mentioned, you guys are pretty concentrated. So if you have an idea that you guys really like, obviously you're going to put pretty significant capital behind those ideas. So I just want to ask, how do you guys think about position sizing? And, specifically, how are you thinking about position sizing entering a very high conviction position?
Yeah, well, you don't just enter a high conviction position, right? Like it's not, you might have a good meeting with management, it screens well. So what we do is we take a toehold position, because it takes a long time for it to be a high conviction name usually, right? So, you take that toehold position, 0.5%, a 1% weighting, and you've met with management and you've modeled it and everything looks good. And then another quarter comes out and they're doing what they said they were going to do. The numbers look good. So maybe you add to that position, and then multiple quarters, multiple years have gone by before it gets to a significant size in the portfolio. And over those years, you've met management dozens of times and talked to clients and customers and competitors, and now you're on top of it, right? It can happen faster than that. It definitely has happened faster than that. But I think that also goes to like the risk side. Like you don't just go out and buy 10% of your fund in a name because you think it's a high conviction name, but if you've done that much due diligence on it, you should have been, starting to accumulate it fairly early on when you saw like the green lights that, it's potentially there, right? So the bottom part of our portfolio, so we're very high concentrated. So top 10, 12 names are 80, 85% of the fund, but we do have what we kind of refer to as like a farm team below that, right? These starter positions, and maybe we hold it for a couple quarters and we boot it out because it isn't what we thought it was, or we do grow it over time and hopefully we do. But that's where the more of the turnover comes from. But that also is from a risk mitigation standpoint. You know it well enough by the time it gets to a size that it could really hurt you, right?
So let's go into some of the reasons for selling. So Jason, you mentioned earlier sometimes valuation gets ridiculous. But before that, I just want to mention your kind of 4 main reasons for selling that I kind of took away from my research into you guys were. So the first one is return on invested capital starts fading. Business is no longer a compounder. The second one, like I just said, is valuations get ridiculous. Third one being management becomes untrustworthy. And the fourth one is that the company ends up taking too much debt for whatever reason. Maybe it's to fund a deal or whatever. So I want to touch on the second point here, which is valuation is starting to get ridiculous. So, what exactly is your framework for an absurd valuation? Is it kind of a matter of, you just kind of know it when you see it? Or do you guys have a more granular system to help you determine when something becomes overpriced?
I'll jump on the day-to-day portfolio management. Jason can touch on it after. So I'll go back to our stock trackers, right? So we're trying to compare apples to apples. So stock A, we own it, it looks good, and the stock price, and we had one that we literally just sold, and it was up 300% over the last 12 months. So when you rank them and valuation is part of it, it starts to slide down the list, right? The growth metrics and the profitability are the same, but all of a sudden that one piece that you're using to rank, drives it down the list. And if you're trying to own the best, dozen, 15 companies that you can own, then why are you owning this thing now? And it starts to leak down to 20, 30, whatever, right? So that's kind of like a relative valuation call. And we've had a few of those where, you know, it looks good, but, you know, at 3x the valuation, maybe, you know, other things look better. So that's the relative side. Jason, do you have kind of other valuation?
No, I just, because in Canada, we don't get much over 25 times in terms of what we own. As far as 25 times earnings would be something that's fairly expensive, right? Whereas in the States, in terms of high quality companies, hard to find anything below 25 times. So it's only just with the U.S. stocks where we have to sort of say, okay, relative to the U.S. market, this is actually attractive. We're going to have to live with it. I think I can live with a little bit more multiple value, a higher valuation than Jesse. I think Jesse's got a little bit more of a value bent than I do. So, you know, once you get over 25 times, it is a judgment call. The key thing is if you're taking money out of a stock that's growing quickly, but it's on 30 times, as long as you're not putting in cash, but you're putting in something else that's growing, you're probably going to be okay. So oftentimes when we sell something, the people, oh my God, but you sold it and then it subsequently went up another 20 or 30%. Don't assume that we didn't put it into something else that didn't do well as well.
Yeah. And Kyle, like you say, like, you know, when you see it. So, you know, a company growing at 30% with 30% margins and trading, you know, it can trade at a much higher multiple than something growing at 20% with 20% margins. Like, you're willing to pay a different multiple. And that's kind of where that ranking kind of factors it all in. Like, how much growth are you getting per unit of PE? And obviously there's more qualitative stuff there too, right? Like, are you comfortable with how recurring and safe the growth is going forward? Or could a lumpy quarter come out of nowhere? And if a lumpy quarter can come out of nowhere and something's trading on 50 times, it can go back, it can go trade on 20 times pretty quick, which would hurt, right? So versus if you're more secure and, you know, they're more diversified or more locked in recurring, then maybe you're willing to pay a little bit more because you know that that bad quarter is not coming around the corner.
So tell me a little bit more about that ranking system. I mean, I think I've probably seen it on your at least on, you know, sometimes you do have a list of 10 to 15 stocks, you'll have, you know, revenue growth, earnings growth, and then the price to earnings for the future growth. Is that kind of how you're constantly evaluating these businesses over, you know, the next quarters or years or whatever?
Yeah. Jason there usually says, like, you know, he goes mirror on the wall, what looks, you know, what prettiest of them all today type of thing. But it kind of breaks down into a single number, right? So you can, it's a bit more complicated than that, but, you know, how much revenue growth, earnings growth are you getting per unit of PE that you're paying for? It's kind of like a reverse peg, right? And again, we're not making investment decisions strictly based off this number, but it gives you a starting position. There's companies that rank high on that we don't own for one reason or another, right? Debt or, you know, not liking management or et cetera, right? So the ranking's a starting position. Is something ramping up the list, then we better be on top of it. If something's dropping down the list, we better be on top of it. That's where it starts. But again, there's modeling, meeting with management and talking to whoever we need to kind of get, you know, comfortable. So it's more of a starting point.
So the other thing that I really enjoyed was your breakdown of future compounders needing three things. So they were 1, profitability; 2, the ability to reinvest at, you know, high rates of return; and then 3, obviously this long runway for compounding for multiple years. So I'm interested most in identifying the ability for a business to sustain the compounding, which I'm sure that you guys spend a lot of time on that as well. So, you know, how are you factoring things like competitive pressures or technological disruption into your analysis process?
Well, one, I'd say every company is different, right? Like, you can't just say, we look for this. It doesn't matter. But I'll go back to that point of, you know, if competitive pressures start to happen, you see it. You see it in growth numbers. You see it in margins. Like, it shows up, right? Or you see it because you should be out there talking with competitors and customers. And so, like, I wouldn't say there's something that smacks you in the face, but like, you're definitely looking for it. And then on the other point, I'll go to when you're talking about, you know, long-term compounders and ability to reinvest at high rates. I think it might have been day one I started working with Jason. He was like, every company is a P times Q. In some form or another, it's price times quantity, which, you know, I kind of refer to as just like the unit economics of the business. So break the business down. Like, how much does it cost for them to make that? How much are they getting for it? Is that good? Right? You know, we have some companies that have phenomenal IRRs right now, something cost them $30,000 to make, and they make $15,000 a year off of it, and it can last 10, 15 years. Like, that's a phenomenal IRR. And if they can keep throwing money back into that, reinvesting back into that, and then, like you said, there's a long enough runway for growth, that's a compounder, right? So unit economics is very important. How much did it cost? How much does it make? Like, can you replicate that over time? That's definitely our starting position, at least.
So I want to talk a little bit about Constellation software here, because it's definitely a favorite of a lot of the people who listen to this. And I obviously am a massive fan of the business. So like you guys mentioned, you've owned it for 15 years, and you started buying it around $20. So it's obviously a massive multi-bagger for you since your initial purchase. So one observation I had, though, was that you don't hold either the spinoffs, Lumine or Topicus. And full disclosure, I own both of those. So I'm just interested in knowing why. Can you comment on your reasoning behind this? Is it because you don't like the fundamentals of the businesses? Is it just like you think Constellation's just better because you got Mark Leonard? Is it a matter of evaluation? Or just please go ahead.
Jason, you probably have your stock tracker in front of you, or if you want to refer to the...
Yeah, why don't you talk, and I can bring up the numbers as far as how the valuations look. But
so obviously we got the spin out, so we did own them. So we owned Lumine for a while, and for a bit there, kind of traded to a higher valuation than Constellation. So again, we run a concentrated fund, so it's not like we need to own all three. We could own all three, but again, when we go to that ranking process, one, Constellation still ranks well, but two, by owning Constellation, you get the upside of further spinouts, right? Which you don't with the other two. So that's definitely part of it. And then for me personally, it is we've been sitting down and speaking with that specific management team for a long time. So there's a type of being comfortable, and then not knowing the other management as well. Like that factors in as well. But go ahead, Jason.
So just on backing that up on valuation, Lumine and Topicus both trade, roughly speaking, on about 30 times this year's earnings, which is they're high growth companies and competitive companies, but Constellation trades on 18. So there's a big valuation differential there. I'm not sure why that differential is. I think for Jesse, remember I said to you, like, I can live with a little bit more valuation. So we tend to get our big positions are ones we both like at that price. I would suspect that if either Lumine or Topicus was to come back closer to 25 times, I think that Jesse would be more open to it. My feeling, and I don't think we're in disagreement with this, it's just where our comfort level is of valuation, is that if you can find a compounder that's growing at 20% a year for the next 10 years, whether you pay 20, 25, 30 times, like the compounding effect will make you a winner. So I think if anybody's listening in on this, I would be very comfortable holding any of those three stocks. In the present moment, though, Constellation is cheaper.
I want to touch back on something that we talked about earlier here, which was some of the tailwinds that you saw back in 2024. So I'll just reiterate, there were declining interest rates, valuations, and also cash on the sidelines. And you had this terrific graph in one of your presentations that showed the performance of the S&P 500 when interest rate yields were falling versus when they were rising, and the differences were just this massive contrast in performance. Yeah. So in a declining interest rate environment, the S&P 500 averaged 14.5% in returns since the mid 1960s. And in a rising interest rate environment, the return dropped to an abysmal level of just 0.8%, which as soon as I saw that made me think of that Buffett quote, which was, interest rates are to asset prices sort of like gravity is to the apple. And when there are very low interest rates, there's a very small gravitational pull on asset prices. So, I would just like to get your views on what you're kind of seeing today. I mean, you kind of mentioned interest rates and where you think they're headed. You think maybe they're in kind of this neutral zone, but how do you see that playing out maybe next year and into the future? And you're obviously still very, very bullish. So yeah, please go ahead and riff on that.
Yeah. So again, we're not macro investors, but I have a pretty strong opinion. But what I would say is, think pre-COVID. So before COVID happened, interest rates had been declining for a long time, and like Jason said earlier, we were facing deflation. Okay, what's changed? COVID happened, supply issues, and they pumped money into the economy, and there was that spike, and we're coming back down. But has anything else changed structurally from interest rates coming down and going more towards deflation? Because guess what? Demographics are massively deflationary right now. I had some stats. The population growth on average the last 5 years has been 0.7. But then I think a lot of people get stuck thinking of the 60s and 70s and 70s of those interest rates. But the population growth was almost 2x, almost 3x the population growth it is now, right? So, and we're heading towards literally declining demographics. Like China is declining year over year. And based on current birth rates, our population, it will start declining. That's deflationary. So there's that side to it. The one is the money printing. Well, the government was printing money for the decade heading into COVID too. And again, we were facing deflation. And then another one is productivity. We haven't really talked about AI, but AI is, we're not even out of the dugout yet. And, you're starting to see massive productivity gains. And if people get, forced to return to the office, like Jason and I were speaking about today, the amount of government workers that you need 2x the government workers to do the same amount of work now because, they're not getting anything done. And so increased productivity is deflationary. So you sort of go through these things and you're like, well, what, that just kind of looks like what it was. And again, I think you can find studies about this, like what is the long-term interest rate over the last 300 years? It's like between 1% and 2%. All right. So I think a lot of people get stuck in the 70s and the 80s, but that was an aberration. Like you were going through a massive demographic explosion, a massive inflationary explosion. That's behind us. But I think a lot of people's minds, especially if they grew up in that time frame and they had to have a mortgage at 18%, like that's stuck in their mind. So all that to say is I don't see a massive spike back in inflation, which is what we faced in 2022. And a lot of that was the supply side. So I have a strong opinion on, no massive spike back in inflation and which means no massive increase in interest rates. Interest rates are still, they're still higher than the nominal growth rate, which means they're, still slowing the economy. So that's my opinion. That's more in the US. Again, Canada is weaker than the US. Canadian rates probably do continue to drop. But that's probably a long-winded answer to macro, which we're spending a lot more of our time on companies. So
you mentioned AI there. And yeah, no, we haven't gotten a chance to speak to that much. But I know obviously from reading your letters in 2024 and 2023, that's an area that you guys have definitely been spending some time on. So talk to me a little bit about AI. Is the reason that interests you, is it because, you think that it's going to, help certain businesses that are maybe not utilizing AI get better into the future? Or is it going to, help tech businesses get even better, whether that's, making revenue growth faster or improving margins? How do you guys, as an overarching theme, obviously it's going to differ between business to business, but how are you guys viewing AI's impact on business fundamentals into the future?
We're already seeing it improve efficiencies. So we own some investments where without being able to have AI on their back end, they wouldn't have been able to scale like they're scaling. Like it just wouldn't have been possible. There's a few investments like that, right? Where they're not AI companies, but they're utilizing it as a tool. I think that's what we're seeing most likely. And we wrote about it, and listeners can kind of go on our website and pull it up. But like anything, there's a lot of hype, there's a lot of trash, there's a lot of speculation, and we're trying not to get pulled into any of that. We're saying, what are you using it for? Like, are you actually seeing results? And we're not investing in AI companies per se, right? Smart management teams find the best tools to improve their business. And if they're seeing it as a tool and they're improving their business, that's what we're already seeing happen to like a decent scale. Jason, do you want to jump in on AI there?
Not much more to add other than that AI is already pretty much everywhere. If you're using a software, as a corporation to, deal with clients, manage efficiency, whatever, there's AI components and all that stuff now. Yes, there are some companies in our portfolio like Propel that's more pure AI, where they have 12 guys from Stanford with PhDs working in the company kind of thing. So we got some stuff that's really AI, but it's in everything right now.
Yeah. And then the other side where we do spend time is, what's if AI does have the growth that it looks like it will, obviously there's going to be massive energy needs. Where does that energy come from? Is that sustainable? So then you talk about, building data centers, or most of them will be powered by natural gas. And you start, so then you do kind of, we don't invest in sectors like, oh, you like this sector. But when things are booming in a sector, you can usually go in and find a really great company that's operating there, right? So,
but even going back to that study that I read about 10 baggers in the US, right? The vast majority of them come from the tech sector. They don't come exclusively from there, but that's probably 75%. Canada's a mirror of that. I would say when you look at our big wins, 75% of them are coming from tech, right? Because the growth comes from the new things. And we live in a knowledge-based economy, and that's where the opportunity is, right? So, and if you're if you're focusing on the knowledge-based end of the economy, then you're running into AI everywhere. And it's not just in the obvious stuff. It's in, we've got, companies like, that do healthcare stuff, right? AI is a big player in healthcare on a whole bunch of different levels, right? So it's in security tech, people, trying to keep buildings and facilities safe. It's in commercial lending, but it's also in sourcing clients, right? Finding people, adjudicating risk. It's everywhere, and it's expanding margins. It's accelerating growth. It's dividing, we see it, we know a couple, or we have investments in a couple of online lenders, or I don't want to call them subprime, but they're not banks that are lending kind of stuff. That have got AI tools, and we see what their growth rate is. And then we know, in Toronto, people that are doing lending that are not doing it that way. And the ones that are not doing it that way are not growing at all. Maybe they're even contracting slightly. And the two that we own that are public are growing at 30 to 50% a year. And you kind of go, I think there might be a bit of a market share thing happening here. And it's the guys that are technologically sophisticated that seem to be growing really fast. And the old school guys, they have a million different reasons to say why, oh yeah, they can't, AI can't do this or whatever, right? It's crazy. I mean, before you know it, they're going to be thinking that they're going to be able to sell books like through the internet or something like that, right? So anyway, it is what it is.
So one other thing I want to mention here was that you guys looked at money market funds and kind of how those were at kind of these all-time highs. So you guys mentioned it was at 7 trillion in November of 2024. Since then, the S&P 500 has moved about 5% as of January 17th, 2024, probably even more today. So I'm just interested, from your research looking into this graph as well as your prior experience, how are you viewing that those money market funds in terms of, what are the lag times going to be like for that cash to eventually be deployed into the market?
After the 2000 crash, and then after the 08 crash, a similar dynamic happened, right? Where people get scared, they go to cash, and in a lot of these cases, it's locked in for a year. But all to say that, maybe rates go up, and it also looked more attractive, but as rates decline, but then also as people just get more comfortable that we're past COVID, or we're past some big block in the road, then they become more comfortable to go back to the market, which over time should give them a higher rate of return, right? So it's a slow bleed. So after 2000, after 08 or 09, like it was a slow bleed, but that money came back into the market, right? So if rates have, obviously the rates that they're getting on these have declined, but then we can also tell you that we have investors that call up and say, my GIC is coming due, and the new price that they're giving me, I'm not happy with. Like, let's roll it over, or let's roll it into the fund. Let's do something, right? Where they're not happy with that new one, but then they're also probably just more willing to take risk now versus, a more uncertain world, middle of COVID per se. But speaking about cash, we refer to the money market funds, but then also listen to the American bank CEOs. Their clients across the board, on the low end and the high end, have never had so much cash just sitting in their bank accounts. They had COVID payouts, they saved most of it, and then so you're sitting, you're hearing. I think it was Bank of America. He's going through all the cohorts, and he said this cohort used to have $200 to $300 in their bank account. They have $1,200 to $2,000 now. That's fairly significant in the sense of being a fairly defensible market. But we don't spend too much time on that. It's just an interesting pattern that we've seen.
So Jason and Jesse, thank you so much for coming onto the show and sharing your insights with me and my audience. So I'd love to give you a handoff and let you tell the audience where they can learn more about you.
Well, I'll jump in and then let Jason finish. But we write a quarterly newsletter and monthly commentary that goes to our clients, but anyone can receive it. So if you go to our website, donvillekent.com, you can sign up. we write about similar conversations like we had today. But Jason, I'll hand it over to you.
Yep. I know a lot of people are skeptical. We just let people read our newsletter. And it's not a marketing tool. We're not going to hit you up for anything. It doesn't cost you anything. You can read it for free. Just realize that when we talk about companies, we already own them. Like, we're not going to tell you about the company that we're just about to invest in tomorrow. But once we're in, so if someone says, what's in it for us? We'd like to share our ideas and engage, but just to, assume that if we're talking positive about a company, that we already own it. But we don't like talk about a company that we own and then people read the newsletter and the stock goes up next week and then we sell it. Like, we're not unethical about it, but yeah, it's part of the discovery process. Is we've found this really great company. There's still a lot of upside. We already got our piece, but there's still lots of upside for you guys. So have a look. And Jesse does most of the writing of the newsletter now. And I think, it's very well received. People like it. It's got a lot of ideas and, it's kind of a fresh look at the market, and a lot of companies that are not, people have already get a lot of exposure to Microsoft and Apple. So it's a lot of companies that go, wow, these are kind of interesting companies, but I haven't heard of them before. So anyway, yeah. So I think if you really want to learn about us, the newsletter is the best place to go.
The kind of stocks that we like are inflection stocks, where there's a change to the business or some strategic shift or something that's going to fundamentally affect the business, or some kind of interaction, some financial change that's going to kind of prove out that the strategy is working for a business, and you kind of see it playing out